I center that distribution on a real interest rate of 2. And on that distribution, there's only a 15% probability that the equilibrium real interest rate is below 1%. Right? And just so, for example, in the most recent summary of economic projections from the Federal Reserve participants, their long-run projections implicitly assumed a equilibrium real interest rate of 3/4 of a percentage point. Right? So in this quantitative assessment, it's very unlikely that the equilibrium real interest rate is that low. And hence, if it is in fact that low, then anything I say about is the ELB still relevant, right? It's even more relevant. So I'm being quite conservative relative to estimates of the ELB. And as a result, the sort of strategies that have developed over the past 15 years, makeup strategies and quantitative easing, are really important parts of monetary policy strategy. Right? Interest rates, this should actually be really intuitive. I'll do big model things. One thing I like to say is in every recession since the 1970s, the Federal Reserve has lowered the federal funds rate by 5 percentage points at least. Right? So if interest rates of 5% are high, right, that means you will hit the effective lower bound every time you have a recession. And you have a recession 20% of the time. So it's likely to be an important constraint. The second result is that strong responses to inflation and activity and monetary policy rules are important for limiting ELB risks and for limiting employment shortfalls. And by strong here, I mean strong symmetric responses. Might be confusing to some. Why is a strong symmetric response to employment help you limit employment shortfalls? Because doesn't that mean that when the unemployment rate gets really low and employment is strong, that you're trying to raise the unemployment rate or slow employment? And the answer is yes, it does mean that. But why does that lower employment shortfalls? Right? Because monetary policy is essentially neutral in the long run. It can't affect the average performance of the labor market. What it can do is it can lower the variance of the labor market. And it does that by lowering upside and downside. If you don't limit upside in a model that satisfies the natural rate hypothesis, well, then in order to satisfy the natural rate hypothesis, you have to have more downside. So the best thing that monetary policy can do to limit employment shortfalls is stabilize the economy, right? And that's how you actually promote labor market strength, by reducing variance, not by trying to raise means. Okay, the corollary of that is that an asymmetric shortfalls approach exacerbates economic volatility, right, and worsens both employment shortfalls and price stability, right? So, and I think that's really important. It's intuitive, and in fact, Galty Edgerson said yesterday in his discussion, well, if you focus on employment shortfalls, you're going to lead to an inflation bias because you're acting asymmetrically. What you're also going to do is worsen employment shortfalls because you're acting asymmetrically and destabilizing the economy. Right, so you're not helping on your employment objective, right? It's like a double whammy. And some people find that counterintuitive, but it's a basic implication of the natural rate hypothesis. Okay, so the research goes through a lot of work. I just want to briefly illustrate it. So here's simulations of the FRB-US model, fit to the US data, trying to characterize what the US business cycle looks like, and assuming that distribution for the equilibrium real interest rate that's centered on 2% in real terms and hence 4% in nominal terms. Here's sort of the balanced approach rule, which is sort of a standard Taylor rule with inertia that Janet Yellen and others have emphasized. And basically, there are 3 results from this table. The first is that you don't meet your inflation target and the economy can be weak because the ELB is binding 15% of the time under this standard rule without quantitative easing or a makeup strategy, right? And then the other results, right, are that, well, with a makeup strategy, you get rid of those perversities, and inflation will equal your inflation target. You'll stabilize output around objective, and you'll reduce variance in the economy. So makeups, the ELB is important, and makeup strategies are effective. In the papers, I go through a bunch of makeup strategies and emphasize that sort of a simple threshold strategy of, waiting to raise interest rates until inflation approaches your objective is a good one. There are many others, flexible average inflation targeting. There are lots of ways to have a makeup strategy. In models, they all kind of work the same. And really probably for policymakers, what's important is what's easy to communicate and simple. Other results in the paper are, answer the questions of if policy should respond to measured slack, and if so, how forcefully and symmetrically. And there are sort of two results. One I won't go into too much, but actually most of the policy rules that central bankers simulate, in big models like the Taylor rule and its standard parameterizations or the balanced approach rule, they're not very aggressive relative to the standards of the rule. They are not on what, John Taylor in the late 1970s introduced as the efficient variance frontier. Right? And actually, you should try harder to stabilize the economy and actually respond more to inflation and more to output. And that's true. That's been true in models for over 30 years. Like if you go back to the conference volume that introduced the Taylor rule, there was another paper by Dale Henderson and Warwick McKibben that considered the exact same rule, and they just said these coefficients are too small in the Taylor rule. Like they don't actually stabilize the economy enough. Right? And that's been true across models. It's basically true in every model I've ever seen. I mean, that's true here. That again goes to this notion of we want to stabilize the economy to reduce employment shortfalls. And you should try really hard to stabilize the economy. And that might mean leaning against periods of economic strength. The columns on here implement a shortfalls rule that has been presented in the monetary policy report and is used by a number of researchers. The equation is here, but basically it does not respond to a positive output gap because they're like, well, look, we like strong employment. What that does is it blows up the variance of the economy and creates an inflation bias, right? Because it just fails to do central bank's first job, which is stabilize, right? You can't make things better if you create instability. So as long as you do stability, maybe you can get better things, right? I'm not looking at optimal policy or optimal rules, but in simple rules, at least make sure that your rule promotes stability. And asymmetric rules of this particular type, at least, don't promote stability. So then when you get to putting those things together, right, how can monetary policy promote labor market strength with price stability? Symmetric policy responses promote stability, which also limit employment shortfalls. Asymmetric approaches to employment shortfalls or activity can lead to a deterioration in stability and actually be counterproductive for what they're actually designed to do. They actually do the reverse of what some hope they would achieve. The paper talks about various, patterns of robustness, and I won't really go through those things. I just want to emphasize the conclusions of my work and then some questions that we can follow up on. The conclusions are threefold, right? The ELB likely remains a significant constraint on monetary policy, right? Makeup strategies, and there are a lot of them that are effective, can address ELB risks, as can quantitative easing. I didn't talk much about it, but really simple threshold approaches, do very well in the models I consider. Second, symmetric policy reaction functions mitigate the most adverse effects of employment shortfalls by contributing to economic stability. And then third, asymmetric approaches actually do the opposite. They exacerbate economic volatility. In the set of papers, including the paper on what lessons we've learned about central banking, right, we just emphasize a lot of things, and it's really all about stability, right? Central banking's primary responsibility is price stability. A second set of issues, that we may talk about is the central bank mandates, have been expanding. Crises have emphasized the role of central banks in promoting financial stability. And the way we view that is that makes a perfect sense, right? Because financial instability leads to price and economic instability. And so it's just a corollary of mandates. But in the work, we also review a lot of the literature that notes that making this effective requires good institutions, and there are arguments that adding mandates, including greater roles for financial stability to central banks, can pose risks to their independence. And then finally, what we talk about, in much of our work on the expansion of central bank activities in the last quarter century, is that goals for central banks other than price and economic stability, complemented with financial stability, may make it more difficult for them to stabilize both inflation and economic activity for several reasons. One is a lot of goals to keep in your head. It's harder to keep all of them in your head. And then the second is a lot of external pressure to achieve those goals, right, can make it difficult to act to achieve any one of them. Okay, I hope this sort of has stimulated some questions from you all, and maybe from Richard as well.
Thanks very much. Okay, so my suggestion is I'm so tiny bit of background. I work in the market, so I'm going to ask kind of simple questions. But the beauty of having you all here is you can ask the complicated ones, motivated hopefully by what you just heard. So I think I'm going to just try and ask kind of three, I think, obvious questions prompted by this whole work. So the first is the effective lower bound still a problem? So if it's still a problem, it seems obvious that we should know where it is and use all the space we have. So I guess my question is, from a European speaking to an American, has European experience over the last 10 years taught us anything about where the ELB is? And in particular, should we stop calling the ZLB and the ELB instead? And secondly, should the location, if you think from a kind of a social planner point of view, should the location of that ELB be dependent on whether it's good news or bad news for a specific set of financial institutions?
So, I think we have learned a lot. I was very careful to call it the effective lower bound, right? Because in the United States, I think we have conducted policy as if the effective lower bound is 0. And I'll get to whether or not, in my judgment, that's a reasonable conclusion. Right? But experience in Europe, has clearly shown that nominal interest rates can be somewhat negative, right? There are costs to holding cash and other things. It's not literally the case that, I'll just focus on the U.S. I do think that institutions matter and the structure of money markets. And one can go back to the set of memos that were written for the FOMC in 2008. I think there were 20, I wrote 2 of them. I think there were 23 or 25. And we sent them to the FOMC. They're all public in November of, late November, early December of 2008. Some of those memos were on what is the effective lower bound and can we set interest rates negative? And there were concerns that in the United States, a large part of deposit-like provision, the provision of money was, and continues to be through money market funds, which actually essentially have near 0 net interest margin, right? And so they're not like banks where they take deposits and put them in loans and have substantial net interest margins. They essentially have very large deposits, and earn a very, very tiny spread. And I think there were concerns that particular structure might make money markets more fragile to negative interest rates than in other economies where actually short-term deposit-like assets were provided by parts of the financial sector that have sizable net interest margins. I don't think that my own view, right, as an economist, is that policy should not be driven to benefit any individual sector, but also that I don't think that was how people were thinking about it. I think it's the case that policy should not be allow its actions to destroy any particular sector that may then have really adverse economic consequences. And I think most importantly now, we know that there are tools to deal with the effective lower bound. Forward guidance and quantitative easing are, in my judgment, based on literature, not perfect, but good substitutes for the regular setting of monetary policy. And as a result, there's really just no need for negative interest rates. So I would just say, why go there? No.
Okay, so you mentioned one of the tools you can use at the ZLB, which is quantitative easing. And obviously there's been a lot done. There's been a lot of bonds bought. But I wonder if I can prompt you to talk a little bit about how exactly you think it helps. What is it doing over and above, someone like you communicating very clearly to silly people like me, what the new strategy is and what the forward path of rates will be in a credible way? What over and above that does buying billions of bonds do in your view?
Yeah, so, I've mainly done research on I've done a little bit of research on how quantitative easing affects financial markets, but for the most part, what I've taken is the research on how quantitative easing affects financial markets and asset prices as a given, and then thought about, okay, what are the implications of that for the macroeconomy? But based on that literature, I think, and we've heard this discussion, this morning in a discussion of some of the papers, there are at least three important ways that quantitative easing affects financial markets, right? One is what you just mentioned. It actually signals the path of short-term interest rates and and supports forward guidance. And that's a very powerful channel. A second channel, right, is that it takes duration risk out of financial markets. And there are institutions that feel they need exposure to that duration. And by taking that duration risk out, there's a stock effect, which lowers interest rates. And because of imperfect substitutability, but some degree of substitutability spills over to other financial instruments and stimulates the economy. And then there is a third channel, and that is that actually by the act of purchasing Treasury bonds or agency mortgage-backed securities, at least in the United States, right? You are affecting the functioning of financial markets, and sort of directly impacting prices there. I think the short version of those last two channels, right, is there are stock and flow effects, and that they might be useful for different things, right? One may be useful for the setting of monetary policy, and one may be useful to intervene in markets and promote financial stability. So I think there are a lot of ways that quantitative easing works. Now that does, I think implicit in your question was a further thing of, well, across those three, which are the most important? And if it really is signaling that's important, should the central bank really be purchasing trillions of dollars of assets and assuming a bunch of interest rate risk that then, while perhaps net neutral for the government, maybe in the long run, or maybe even positive for the government fiscal position in the long run by supporting economic activity? And I think there are arguments you can make that the net effect, even in the current episode, across very strong remittances and then central bank losses from holding long duration assets, is actually positive because of the positive effects on taxes. You may say, well, is that really the central bank's job? Should they be assuming that risk, or should that be something on the Treasury? I think those are legitimate questions, and go back to the questions on central bank independence. Because signaling is, I think, one of the two really powerful channels, it might be useful to think about. Like in my research, I've always emphasized forward guidance, but unfortunately in the models, forward guidance is maybe too powerful. And I don't mean that for the reasons that sort of Oliver was talking about in his discussion. I think we have models that fix the forward guidance puzzle, but even in those models, maybe forward guidance is better than it is in the real world because it's hard to talk to financial markets. But I certainly think that the experience of the last several years suggests that quantitative easing is really effective. It works through a number of channels, but we may want to be revisiting its role in the toolkit, because there are sort of ups and downs, in the public support for the central bank that may accompany quantitative easing.
So I know you said that this is one, probably you've written on very many things, but this is one thing you focus so much on. So I'll pose the question, if you can move on if it's not interesting. I'm going to put two quick follow-ups would be, one, I think you said what I think everyone says, what people in my industry say all the time, which is by doing quantitative easing, you make the signal, the guidance more credible. And I kind of think it's all right for me to say that. But I'm always interested when kind of academics say it. I'm kind of tempted, I'm prompted to ask, well, what's actually the mechanism? Because there are some papers out there that provide mechanisms, but I don't think they're ones that any policymaker would usually like to make, in terms of, well, now I've got the bonds on my balance sheet, I've got to set interest rates differently. So I'm a bit interested in that. What actual good is it doing? Is it any more than waving a flag at the same day? It's a very expensive flag. At the same time, you give guidance. And the second follow-up was going to be, I posed my first question about the lower bounds as a European. I'm not Japanese, but if I was, I might say, you talked about forward guidance and quantitative easing at the lower bound. how about yield curve control? And that was something the Americans did a long time ago. Where does that fit in as well in terms of things we can do if the effective lower bound's a problem?
Yeah, so I think it's a really interesting question of what is the mechanism behind the signaling channel, and its importance. I think the empirical work is that the signaling channel, is powerful. I personally, in thinking, about what actually happens, don't ascribe much to this notion that central banks, get trapped with these long duration holdings and are unwilling to experience losses. I mean, for example, casual observation suggests that that is not the case. Maybe it's not economics, although I guess behavioral economists would say that it is. I do think there is just something, right, that when central banks do something, it reinforces what they said, even if it's hard to write down the model of why exactly it reinforces that. And it's a little bit like the Mario. It's a mini tiny version of the Mario Draghi, whatever it takes. It's like, look, we are in this and we're doing everything we can. And I think it's also the case, right, that that's important because it is, in my view, part of we are doing everything we can and we're using tools that we have, because quantitative easing does not only affect the economy through signaling channels. If it only affected through signaling channels, then I think one would be caught in this, well, wait, why does the signaling channel work? Because if you're doing this thing only because of a signaling channel, well, then I better really believe you, or you're going to stop doing it. But wait, if I don't believe you, then there's no signal. You get in this, then the question you ask is really important. But if you're doing quantitative easing because it actually does affect asset prices directly through portfolio balance channels, then the signaling channel is simply complementarily. And I don't think there are quite these, theoretical challenges of like, oh, are we caught in this hall of mirrors? And if I stop believing you, will bad things happen?
If you can move the term for you, it's different.
Yeah.
Any thoughts on yield curve control then if we're in the...
I think my main thought on yield curve control is, that at least in the United States to date, I think forward guidance and quantitative easing, how they've been conducted, have worked. So yield curve control is a solution to a problem that we have not yet had. That doesn't mean it's impossible, but I'll wait till we have that problem to think about whether we need that solution.
So I'll ask one other question that I think was doing the rounds in about 2019. Again, certainly in Europe, because I think this was a bigger problem in Europe. We were obviously much closer to the lower bound. We were below zero. So the other question was, well, if at some point there's a reversal rate out there in Brunel's literature, I can't reduce the lower bound, but I seem to be there. The other way that people thought we could solve this problem, make the constraint less binding, is if I can't move the bound, I'll move the average level of interest rates up. So I can't move R star, but I can change the inflation target, and that's going to give me some more room. I think I know what your answer is going to be. How do you think about all those kinds of discussions about if you could wave a magic wand and credibly raise the inflation target, if you kind of credibly do it without setting the horses loose? How do you think about that?
So I think that the effective lower bound is one, and as though I still think it's an important constraint, right? And the question is, how sizable is the constraint and how can you deal with it? My sense of lived experience, but also then simulating models, which I think is useful and can actually, give you results that are different from lived experience, that both of them suggest that, at least for the United States, for the range of equilibrium real interest rates that are plausible, that forward guidance and quantitative easing are sufficient to achieve an inflation target of 2%, close enough. Now, in my work with John Roberts, and Ben Bernanke, we did emphasize that the inflation target is symmetric. And so you should be on both sides of that. And part of that means that, and like John Roberts and I explicitly emphasized this in our 2017 paper, right? That like typically it's the case that, because demand is one of the factors that affects inflation, if you're in a long economic expansion, inflation should be above 2%. on average in expansions, because during recessions, again, there are supply shocks and everything, but during demand-induced recessions, on average, inflation is going to be 2%, below 2%. So that doesn't mean that you seek inflation of above 2%, right? It means that a policy that on average seeks inflation of 2% will be consistent with, during long expansions, inflation being a little bit above 2%, and during recessions it being below 1. That's not raising the inflation target, but it is not being an inflation nutter. Now, I do think that the situation can change, right? I think people's sense right now is that the risk is that the equilibrium real interest rate is higher, and but if actually the equilibrium real interest rate were below 1 or 0 or negative, which I think people were somewhat concerned about in 2018, the story could change, right? But that doesn't seem like there's much evidence for that for the near horizon.
Got it. Okay, I've asked plenty of questions, so I'm hoping you'll have plenty of your own. We got people with mics walking around. I see we have. Just stick up your hands. Okay, so why don't we start here up to the row?
Tomasz Wilarek from T. Rowe Price. So I'll ask one controversial question and one perhaps a bit less controversial one. So the controversial one is, if you think about makeup strategies, and if you look at what inflation has actually done over the past couple of years, being so far away from target, and if you think about average inflation targeting, wanting to be around 2 on average over a decade, let's say, doesn't that mean that policy should be very tight and inflation below target for a prolonged period of time, perhaps even deflation, if you believe in average inflation targeting? And if it doesn't mean that, then the question is, are makeup strategies that are symmetric actually credible? And if they're not credible, then the question is, why use them at all? Then my second question was perhaps a bit simpler. Ben Bernanke had this big review of the Bank of England here in the UK. His recommendation was to use scenario analysis for communication. And my question to you would be, is that something that also the Fed could learn from, use more scenario analysis in its communications?
So maybe we'll take them one at a time. I think that's a great question about makeup strategies, but to me, it just illustrates, that you need to be really precise about what you mean by makeup strategies, right? A makeup strategy is a strategy that makes up for what happens at the effective lower bound, right? So it is asymmetric. It's 100% clear. And because it's asymmetric, because that problem is asymmetric, and that leads to symmetry in inflation. There's absolutely no, it would be double counting and odd to then, when inflation goes above 2, to try to reverse that. What is the asymmetry you're trying to reverse? So that's certainly conceptually completely irrelevant. Makeup strategies, in all of my work, right? The asymmetry is clear, and hence they clearly act asymmetry in an asymmetric way. I think you tried to tie it to sort of current circumstances. I don't think there's very much evidence that any makeup strategy contributed to current circumstances. So I don't, that's not my read of for example, Gauti's paper yesterday, where I think he was pointing to other, sources of strong aggregate demand.
Do we have other questions?
Thank you. So my question is about monetary policy going forward. I would like to ask, in your view, how monetary policy should or whether it should respond to climate risk. In principle, there are 2 answers to this question. One is, it's like a negative supply shock. It will impact output and inflation. We have the Taylor rule. We know how to respond to that. So we don't need to think anything beyond that. The second answer to that question would be, well, actually, it's a completely different type of shock of completely different proportions. All policy needs to be rethought, redesigned, including monetary policy. I would like to know where you are on that spectrum.
Yeah, so Just a couple of thoughts, right? So again, I'm speaking as a researcher, not for the Federal Reserve, and the Federal Reserve has clear, responsibilities for price stability and economic stability. We do in my paper with Rick Mishkin talk about how central banks, may want to consider climate-related risks in the setting of monetary policy. And what we say is that, to the extent climate risks affect economic and price stability, right, those are the objectives of central banks, and that central banks should clearly take climate into account through that lens. Now, you mentioned two ways to think about that lens, right? One is it's just a different name for the same types of shocks that might happen. And the second is it's a new source of shocks that may have different dynamics, and that I think what central banks should do, in response to that aspect of your question is figure out which of those is right. And then, whichever that is the case, right, act to promote economic and price stability. There may be uncertainty of whether or not climate is, I think this morning, right, it was referred to as well, as this show up as like a cost push shock in one of your equations, and that sort of would be just relabeling it as something we see in our models, a shock that's very common, and we know how to respond to it. I think it's a research question of if it's a different kind of shock. The answers to that question then will be the answer, right? But central banks should focus on promoting economic and price stability.
Yeah, as you probably know, there's a sort of quite a long-running and now extremely stale and tedious debate in the UK about whether or not people should, NBC members or the committee should announce a path for interest rates going forward, as opposed to simply taking every meeting as it comes, as people say. I find this a bit weird in the US. Very frequently, you have a dot plot from the Fed, and the debate is, oh, look, the markets are massively disagreeing with the Fed. So we can see in an environment where we have forward guidance in some sense in the form of a dot plot that the markets don't take it as a commitment and they actually disagree with it for quite prolonged periods in many ways. That's just a prelude, really. But I was just wondering how you feel about how the dot plots have worked in the years since they've come in. Are they being used and interpreted appropriately? Do you think we still need them? Is forward guidance less important now that we're away from zero low bound and so forth? I think you'll probably say no to that latter one, but just maybe expound on what job you think the dot plots are doing. Could they be done better?
Yeah, I mean, I think just stepping back and looking at that set of questions through the work that I've done, I think that at the effective lower bound, forward guidance is really important. It's one of the key tools. More generally speaking, right, the way that monetary policy affects the economy in all of the research that I've done is by managing expectations through a clear policy reaction function that markets, households, and businesses understand, right? And that, for that reason, right, it's really important that central banks communicate effectively, but I have not, myself conducted work sort of evaluating the dot plot, so I can't really speak more specifically to that.
Thanks a lot for presentation. That was very clarifying number of important aspects. I guess my question is related to the past review of the monetary policy framework that the Fed had in 2020, if I remember correctly, or at least was published in 2020. And my recollection was that everything was game, but the level of the target. If I understand also correctly, there's another strategy review that is going to happen soon. Will the level of the target be considered, or maybe more directly to you, you think it should be reconsidered?
Yeah, so, as the FOMC sort of previewed when it rolled out its last framework in 2020, and as Chair Powell has reiterated in his recent communications, the Federal Reserve will consider a review of its framework starting later this year, and conducted over the course of 2025. So that is happening. That was the first part of your question. And then the second part is sort of, do I, based on my research, right, which I think is all I can speak to, combination of forward guidance and quantitative easing seem able to stabilize the economy very effectively for reasonable values of the equilibrium real interest rate and an inflation target of 2%. It does require that central banks remain committed to using forward guidance and quantitative easing, when appropriate, but conditional on that, my research would suggest that an inflation target of 2% is a good value, and I can't really speak to anything the FOMC might do.
Can I ask you a quick question coming back to the point that Thomas raised, which is, do you think we've collectively relearned something that, well, we maybe should never have forgotten, which is, it seems like the general public really don't like very high inflation in a way that may be comfortable enough with little to no inflation. Is that at all relevant to how we how you will write down loss functions and design rules and evaluate their performance and the rest? Do we just say, okay, people are people, but we know better, or actually it doesn't matter, we've got this? Which I think is kind of the force of Thomas's point. Do we just ignore the fact that the public have hated this inflation episode?
So I certainly don't think anyone should ignore. I don't think any civil servant should ignore the public on any issue. And we've learned a lot about inflation. Now, right, inflation in the United States in 2022 on a PCE basis, which is the Fed's preferred measure, right, it peaked at 7%. Right, that is nowhere near any reasonable view of the inflation objective. So, put to Andrea's question, I don't think we've learned anything that says that 2% is much too low. Have we learned that they would really hate 2.5 or 3? 7 is really different from that. So maybe we haven't learned that. I would say, and again, just going back to my own research, people talk about the Fed's 2% inflation objective as if it kind of just happened, and 2% is an arbitrary number, and it just was like made up. Like, I think you can go clearly back to the behavior, and this is my own judgment, but it's based on work that I've written. You can go back to the FOMC's behavior, and the adoption of the explicit numerical price objective in 2012, and see that that's just not the case. The FOMC was actively discussing its inflation objective in the late 1990s. It had a clear articulation, which I think is very relevant for your question, of what price stability was, right? And that is that price stability is when households and businesses don't need to care about inflation. Households shouldn't need to worry about inflation, right? That was how Alan Greenspan defined price stability, and it's a pretty good definition. It's clear that that's a good definition, right? Because they hate inflation. They shouldn't have to worry about it. And if central banks, control inflation, they don't have to. Right? So that would suggest, that in 2007, I wrote a paper. It was an internal Fed paper, but it became public many years later, on setting the inflation objective. And we considered the effective lower bound, like what is a reasonable value? And we considered the large literature on the cost of inflation. And we went through all the things, like the cost of holding money, the imperfect indexation in the tax code, nominal wage and price rigidities, and all those costs that are emphasized in new Keynesian models, right? The costs of planning and people's inability to plan, right? And we also reviewed the literature. And actually all of those things add up, but they don't seem to connect with what people say. And people say they hate inflation, right? Bob Shiller wrote a paper on this in 1996. And Stephanie Stancheva has a series of papers this year on this. It's like people really feel that inflation is costly. They are confused by it. They find it hard to understand. They think it's really unfair. Right? And we should not dismiss those findings. That research says people hate inflation. They find it really confusing. It's hard for them to deal with. Right? When we did that work in 2007 and updated it in 2012 and others, we looked at the experience in the United States where inflation had averaged 2 for about 2 decades. And we were like, this is pretty good. It wasn't an arbitrary number, right? It was based on a lot of I don't know how the FOMC decided, but I know that they received memos that I and others wrote, right, and thought really hard about the lived experience, right, and that 2% was a pretty good number.
Just to probe again to the point from the back of the room. I'd heard similar stories in the UK. I'd always understood that a big part of that calculation is costs and benefits was indeed exactly to the point of this presentation. Proximity of the ELB, then zero low bound for us back then, and essentially a judgment on where our stock was. And that gave you your room. So back then, when these calculations were done in the 90s or in the noughties, we probably thought our star was higher, and therefore the amount of room you needed was contingent on that. If you change your view on where our star was, then you might have needed a higher inflation target. It kind of goes back to this question. 2% is a number we will accept, and we know the public don't like 3, 4, 5, 6, 7. But that, I think it's fair to say, or well, you tell me, is it not fair to say that 2% number did come out of a calculation based on a historical view of R star, which at least up to 2019 was increasingly looking out of date and too high?
So, I mean, again, what I can say is what I've looked at in my research. And so, for example, in 2007, I wrote a paper on setting an explicit numerical price objective. And a small part of that paper was on ELB risks. Another small part of that paper was on downward nominal wage rigidity, right? But a much larger part of that analysis, or co-equal was, is 0, 1, or 2% inflation. How do households feel that, right? How is the economy doing, right? So I do think it was an important factor. And I can say, right, because it's a public memo, right, that we considered numbers like 1 or 2, right, but we didn't consider numbers like 4 or 5. No.
I think
I'm sorry, but it's clearly very interesting. So I have just one more, and it's about the future of monetary policy. So if you thought for a second, and Richard already mentioned YCC, but if you thought for a second that the size and expansion of the Feds or any central bank's future balance sheet expansion is constrained by the idea that people associate it now with inflation, right? A lot of people may associate central bank balance sheet expansion with inflation, given what just happened. Is the future of QE or of central bank government bond intervention more like Operation Twist rather than YCC, where the Fed or other central banks basically are duration managers in government bond markets?
I mean, I think it's important for central banks to have tools like forward guidance and quantitative easing. I think they're complementary, right? And it's useful to think about, how to do that most effectively. I'm not sure I could speak, more specifically.
I have one, I think, David. So I was going to ask, because this slide is still up here and we never really addressed it. Sorry, we got stuck on the main body of the presentation, but there's this really interesting stuff here too. So I was going to prompt you to speak more about the kind of final bullet, and in particular what you mean by financial stability, because obviously going back a long, long time, central banks had kind of responsibility for making sure the banking system didn't fall over. But you could take the long view and say the really big misses we've had on economic stability typically come after financial crises. And where do you see, in terms of where you and Rich can end up, macroprudential policy? Does that belong with climate change and something too big a burden to put on central banks and leave it to someone else? Or do you think, no, that's central bank expertise, that's part of economic stability, they should be doing it? So where do you think our financial policy committee should sit, inside the central bank or outside?
Yeah, so, this is something that, again, I've talked about in my research, and it's covered pretty extensively in the working paper that's coming out as a handbook chapter with Rick Mishkin. And so financial stability contributes to economic and price stability, as you just said. And hence it is, at least in principle, complementary to central bank mandates and something that is valuable for them to pursue. I think when we look at the literature and experience, we emphasize two set of tools that complement the reason for why central banks should be involved in financial stability. Right. One is that, historically, central banks have had a role in many economies, not all, in supervising the banking system. And the banking system is often at the core of financial stability issues. And hence the central bank may be well placed to consider financial stability and the promotion of economic stability. In the US, the researcher that I consider most associated with that point of view is Eric Rosengren, who was a former president of the Federal Reserve Bank of Boston, and sort of emphasized how the information that we in the Federal Reserve receive as bank supervisors is really valuable for promoting economic stability, and that we can use the supervisory and regulatory tools as a complement. A second reason is that the most instances of financial instability involve, not all, but most, involve sort of trouble associated with money. Liquidity provision is often important for strains, among financial institutions. The system may be experiencing a run, and needs liquidity. And the central bank is typically involved in the provision of the payment system, and hence has responsibility for the rails that often are useful in a financial stability. So those are two reasons that are sort of obvious that the central bank should be involved in financial stability. We then also talk about macroprudential tools, which are different and more forward-looking, right? Of like regulating levels of credit or other things across banks or across non-bank sectors. And there, those things are complementary to supervision and regulation. They're complementary to what I just said, but they also are different, right? And so I think, it's what we say in our research is that a lot of countries have decided to make central banks involved in those things. It seems perfectly reasonable. They seem very complementary, but they're not as closely tied as that lender of the last resort involvement in the payment system, or the sort of core, just what information do we have? And so there are countries where some of those macroprudential responsibilities are held by the finance ministry or another part of the government. And I think we're still learning of what the optimal mix is.
Got it, David? Okay, I think I got the message. It's time to wrap up. So I just want to say, I'm sure on behalf of everyone, thank you. It's a fascinating talk and kind of really directly answered people's questions, which I think is great. So round of applause, please, for